Financial Freedom Show. My name is Rob Berger, and I have absolutely no idea if the live stream is working because I've had technical difficulties. Hopefully it is. Hopefully I'll get a thumbs up here soon. For those of you who thought the show was going to start at 8 p.m., that's because earlier today, that's when I said it was going to start. Actually went to a funeral today and didn't think we would be home in time to start this at 7. So I set it up for 8, and then we got home in time, and I thought, 9:30 is my bedtime. So, probably should start this thing at 7. And so that's what I decided to do. And I got a thumbs up already. Thank you. Appreciate it. By the way, a big shout out to my cousin Lee. She may be watching. I went to her retirement party this weekend in Ohio. I love going back to Ohio, particularly where she is down on the Ohio River, where my mom grew up, seeing the family. It's always a lot of fun. And I don't get down there very often. And it's nice to go down there for a positive reason, as opposed to where we were today, different situation, but it's all part of life. So I'm going to get to your questions, but I want to kind of talk about an idea, the awesome power of blaming yourself when something goes wrong. And there's a number of different things that brought this to my mind. One of them, and so I want to share this is just sort of for 5 minutes. I'm going to share a few thoughts with you on this. And then I'll get to the important stuff. But this probably first came to my mind when I was interviewing Brandon Turner, who used to be a part of biggerpockets.com, which is a site for real estate investors. If you're interested in investing in real estate, can't recommend BiggerPockets highly. It's a great site. I knew Josh, the founder, working. I haven't seen him in a number of years, but in any event, Brandon worked there. He now runs Open Door Capital. So if you're interested in investing in real estate, I've signed up. I haven't invested in anything. I get notices of their deals, but I haven't done a deep dive yet. But Open Door Capital. Anyway, I interviewed him years ago. He was, he's been a landlord. He owned not just like single family homes. He owned apartment buildings. So he was really into this stuff. We were talking about what happens when a tenant doesn't pay. And particularly if it gets to the point where he has to evict someone. And one of the things he said, I always remember this was years ago. I interviewed him long before I had the YouTube channel. He said, I always ask myself, what did I do wrong? And I thought, in the interview, I don't remember how I responded, but it was, as best I recall, it was like, well, what do you mean what you did wrong? You're not the one that didn't pay. He goes, yeah, but even if I'm not technically the one at fault, legally or even morally, if it's a moral issue or, right or wrong kind of thing is what I mean when I say moral, you can still learn from it. And you can always ask yourself, what could I have done differently to perhaps have a better outcome? Even if by all, everyone would agree it's not my fault, right? And so in that case, he's thinking about the process of vetting tenants and evaluating them and sort of all of that thing and working with them when trouble arises. And I was really impressed by that attitude. And that stayed with me for a long time. And then I see things like this. I'll show you here, see what it looks like. There we go. Let me make it a little bigger. This is from our friend Kathy Wood at ARC. And I think she wrote this, or someone at ARC did. I think it's Kathy did. Let's just go to the top here. Let me accept the cookies. There we go. This was back at the end of last year. Things were not going well for some of the funds. They've gone even worse. And she spends a fair amount of time in this article talking about benchmarks like the S&P 500. And something that got quoted frequently, maybe get rid of that. She's big on believing that our bigger risk is deflation, which who knows? I mean, right now it's not, but maybe that could change. But here's what I wanted to show you. It kind of summarizes, I think, this article. I'm getting there. Here we go. We will not let benchmarks and tracking errors hold our strategies hostage to the existing world order. Now, to me, that's like red flags everywhere. Like, my money ain't going anywhere near that kind of thinking. First of all, I don't even like the language hostage, existing world order. I don't even know what we're talking about at this point. It's like evoking these sort of emotional. It's almost like it's trying to feed into a certain, I don't know, worldview, or it's bizarre almost. But here's the bigger issue is the funds had done very poorly. Now they've continued to do worse. How does, as a leader, do we want the people in charge to respond to that? And what I would want to hear from her if I were investing in ARK, and I'm not, but if I were, the very first thing I would want to hear is, boy, this has been a rough year. Things have not gone well for us at all. The fund's been down X percent, blah, blah, whatever the case may be. Now, as part of that message, it may be, we think we've got a very good long-term approach to investing, and there will be times when we'll nevertheless significantly underperform the benchmarks, say the S&P 500. Okay, and state your case. But it's almost as if there's no humility. It's almost, and it almost zaps you of your curiosity. I want her to be curious. When I say her, I mean, in this case, anyone, if anyone were managing my money, the last thing I would want them to lose is their curiosity. Look at that. We got destroyed this year. What caused that? Did I miss anything? What went wrong? Let's do a post-mortem here. Maybe nothing went wrong. Berkshire Hathaway at times has been down 50%. Of course, when it was, the market generally was down. But if you can't even step back and say, okay, here's what I think happened. Here's where I think we went wrong, if any, it gives me really grave concern. And I've seen it with Michael Saylor, who's the CEO of MicroStrategy. He's the one that basically turned his software company into a Bitcoin ETF, effectively. It owns its basic value is now Bitcoin. And I've watched a lot of interviews, in part because I question my own views of Bitcoin. I say, well, maybe I missed something. Maybe, I don't think Bitcoin's a good investment, but I don't know, maybe I've got that wrong. Let me listen to people who are Bitcoin, proponents. They just, are big into Bitcoin. I don't see any humility in him, in the way he describes his views, or there's no, this is my thesis, but, I could be wrong. This could turn out badly for me and the company. And here's how that might happen, actually. Here are some ways this could go off the rails, but I nevertheless believe in this approach for whatever reason. You don't get that. And I think we need to be very, very careful and try, to the extent you're going to ever invest in an actively managed fund or an individual company. We have to be very careful when those that are managing what is effectively our money, right? Don't have that curiosity and that humility and willingness, by the way, to say, yeah, things really didn't go well this year. It didn't go well. Let's talk about it. Let's try to figure that out. Someone who's very good at that is Warren Buffett. And I was watching, I'm going to show you something. I don't know how well the sound is going to come through, but this is the Berkshire Hathaway meeting. That's Becky Quick. She is with CNBC. She asked some of the questions that were sent in by shareholders. And the one I want to show you is this one. Let's just listen to this. We're going to listen to a little bit of this video. I'm going to stop it at times and talk about it and go back and forth. Let me see here. Can I get fancy? Maybe not. Oh, there I am. Yeah, I'm in there. Okay. That's fancy. Look at that. I'm in the corner. All right.
BNSF and Geico appear to be losing ground to their two primary competitors, Union Pacific and Progressive. Over the past several years, UP's operating ratio has been about 400 basis points better than BNSF's, and Progressive has grown faster while maintaining a lower combined ratio than Geico. On an operating basis, UP's precision scheduled railroading and Progressive's telematics appear to have jumped ahead of the Berkshire businesses. He wants to know what Greg and Ajit are doing to address those business challenges.
All right, let's just talk about that first. So BNSF is a railroad, right? Geico, of course, is an insurance company. And effectively, as I understood the question, it was, hey, your competitors are eating your lunch. They're operating more efficiently than you are. And the question is to Greg and Ajit. So, this is, of course, Warren Buffett and Charlie Munger are there, but Greg and Ajit are sort of the number 3 and 4, I guess, guys at the company, or maybe second and third, because Charlie Munger really isn't involved in operations. But in any event, they're going, they will be successors, particularly Greg. In any event, they run significant portions of this business, Ajit, the insurance side. So he's going to answer in a minute. He's going to answer the Geico question. But first up, we have Greg, who's going to answer the railroad question. And so I want to look at how they are answering these questions, because I think their approach is very different, actually. So let's take a look. By the way, I hope you can hear it okay. It's not running through my system, so it's going from the speakers to my microphone, but hopefully you can get the gist. There we go. So this is Greg answering the railroad question.
Thank you, Becky. Let me just start by saying, when we think of BNSF, we have an exceptional franchise there and a great business. And we do compete with other railways, and we're very well aware of how they operate, including their operating ratios and the metrics they operate to, and precision railroading, and it's all part of it. But what I would share with is, when I think of BNSF, we start with focusing on our customer, understanding how we can best service them. And yes, we want to do it in an efficient, effective way that delivers great results back to our shareholders. And that will continue to be our focus. So yes, we learn from all the metrics.
I'm going to stop it there. So there's more to it, but basically that was the gist of his answer. And I didn't really care for that answer. First of all, he didn't even acknowledge if he agreed with the question. Are the operating ratios, are they not as efficient at BNSF versus their competitors? That's question one. You should acknowledge that. If they're not, you should just say so, and maybe talk about why. Now, there could be limits to what he can say for competitive reasons, and I get all of that. But I really, I really didn't like that answer. It just, by the way, I'm not comparing it to anything suggesting that they're not going to be held hostage to benchmarks given the current world order or whatever she was saying. That's all on a different level. But this, I don't know. Let's compare it to Ajit, and I'm going to fast forward a little bit. So pardon me while I do that. But we're going to get to the Geico question here.
Beside our rail customers, both we've got to because folks also.
By the way,
a journey ahead of us.
Let's just listen, because Charlie Munger interjects a question to Greg.
So we're going to continue to get better and better.
Greg, if we were ever the opportunity, would you trade our operation for theirs?
Never. And we love.
He knows a lot about it, Phil.
I mean, to me, again, that's like, what do you mean never? Why? Why is ours so much better, particularly if we're not as efficient? Anyway, I was not happy with that answer as a Berkshire Hathaway shareholder.
And Greg,
I'm going to skip. We're going to go to Ajit.
They know how to run businesses.
Actually,
I mean,
here we go.
Charlie, I kind of was asking similar questions.
Okay, thank you, Becky. There's no question that the personal automobile insurance business is a very competitive business. Having said that, both Geico and Progressive are two very successful competitors in this segment. Each one of them have their pluses and minuses. But having said that, there's no question that more recently, Progressive has done a much better job than Geico, as you point out, both in terms of margins and in terms of growth rate.
Right there. Boom. That's what I want to hear. That tells me he's got his eye on this. He knows it's an issue. He's not trying to, obfuscate. He's not trying to, dodge the issue. It's just straight up, yeah, we got a problem, and we know we do.
There are a number of causes for that, but I think the biggest culprit as far as Geico is concerned, and again, you rightly pointed out, is telematics.
I'll stop it there. All telematics is, that thing you can plug into your car and it monitors your driving and maybe you get a discount. Geico's been real slow on using that. And I won't keep going on his answer. Basically what he says is they should be caught up in 2 years. And to me, that's an A+ answer. So I just kind of wanted to share that as I think through my own my own sort of life and on all kinds of issues, not just investing. When something goes wrong, it could be about investing, or it could be, a chess game that I'm playing that's gone terribly, terribly wrong. Sometimes my first reaction is anger, particularly with chess. I don't know why that is. And I have to remind myself, Rob, stay curious. What went wrong? understand what went wrong and how you can try to fix it. And I think that's a good general approach to take in life, even when, something goes wrong and it's not your fault. It's not, it would clearly be someone else's fault or just bad luck. Still, is there anything you could do or could have done to maybe, have a better outcome? I just think it's generally a good, healthy approach to take. But when it comes to managing our money, and particularly if we're going to let someone else manage it, which you're doing, well, you're doing it as an investor, even in an index fund, but you're certainly doing it if you're in an actively managed fund or if you're investing in individual stocks. And I thought Greg's answer I didn't like, honestly. I hate to say anything negative about Berkshire, but I didn't like it. I thought it was didn't answer the question. And Ajit just answered it straight up. And I just loved that. I thought I'd share that with you today. There you go. All right. Now it's your turn. Questions. By the way, I rarely trade stocks. I actually did some trades on Friday. I sold some Wells Fargo because I had a lot that I could sell and do some tax loss harvesting. Schwab, by the way, has an interesting thing where you can, in terms of the tax effects of a sale, you can select an option that says you sell my shares in whatever order, in whatever lots will maximize my tax losses. So you just do it for me. Well, that's pretty nifty. There might be times when you don't want to do that, by the way. But so I sold some to harvest some losses and just immediately put it in Bank of America, right? So there's no wash sale rule. And then I don't know if you guys follow Deere and Company. I followed Deere and Company for years. I think it's a great company. And they had a good quarter and their stock on Friday dropped 14%. And so I took a position, not a big position, but I bought some. And I think the price was reasonable. The price currently is within the range of what I would consider intrinsic value. And for me, that would probably be a pretty big range. Maybe if I knew the industry better, it might be smaller. If I were Warren Buffett, it might be really small. I don't know. But for me, it's a pretty big range, but it's within that range. It was on Friday anyway. So yeah, I did that. And so, basically, I wouldn't mind moving all my Wells Fargo to Bank of America just to simplify the portfolio. I like Wells Fargo as an investment. In fact, it may do better than Bank of America over the relative short term. But either way, I would have Apple. Let's just say Bank of America. If I got rid of all the Wells Fargo, Apple, Berkshire, Bank of America, and Deere. And honestly, that's a pretty diverse portfolio. 4 companies. It's the smaller part of our overall portfolio. But Larry Lane, welcome. I never got to get to see you live. This is nice. Well, I'm glad you're here. All right. This, I have no idea what that's about, but okay. I'm sure I said something. Well, this is just true right there. I wonder if VJ's in the house. Okay. Well, I can review it at a high level. So Steve says, can you review your method of picking individual stocks? You have mentioned it in past videos. Thank you from an OSU grad. I hope that's not Oklahoma State. I tell you, nothing infuriates me more when I Google OSU football and it brings up Oklahoma State. That's just wrong. Anyway, I can. You may find it disappointing. So I am looking for companies that I think, forget the price for a moment, but they've got a great brand. They've got some pricing power. They're doing smart things with the profits that they make, reinvesting it wisely, doing buybacks when it makes sense, distributing dividends if it makes sense, not engaging in ridiculous transactions, and just have a good track record of regularly growing revenues and profits. Now, Deere is a little interesting compared to some of the other. Well, maybe banking could fall into this category. Deere is obviously influenced by, say, for example, commodity prices, right? Particularly food, right? So, of course, it sells more than just farm tractors, but there were times, particularly when commodities were down, when it was was struggling. through those cycles, just like a bank can struggle through a cycle. And if we hit, if we hit a stagflation period, banks could struggle. Just depends. But these are companies that I think have done well long term, and I just wait until I get a price that's reasonable. Now that's not. I don't have some formula. I can't say, well, you just you use the PE or the PEG, price earnings divided by growth, or price to book. I do focus on price to book with banks, but I just look for what I think are good companies, and wait for what I think are reasonable prices. I keep my number of companies very small. I have 5 now. If depending on taxes mainly, I may end up getting rid of the rest of Wells Fargo. I like Wells Fargo, and it's actually been done very well for me. But I can just consolidate it all into Bank of America, and I'd be fine with that. So I would have 4 companies to monitor, and frankly, I probably don't have any plans to add a 5th beyond that, for at least for the foreseeable future. And I'll read the 10Ks when they come out, the 10Qs, listen to earnings reports, listen to the CEO, and look at things like Greg versus Ajit. I don't mean to pick on Greg at Berkshire, but I just didn't like that answer. Do I hear that kind of competence and confidence? It takes a lot of confidence. For Ajit to sit there in front of, 35,000 people at the conference center and presumably millions watching around the world and say, he basically has arms folded back like this. And he says, Progressive has done a better job, but here's what we're doing about it. That takes a lot of confidence in yourself, in your team. Anyway, so I look for that kind of thing in leadership of companies. And I would say, to be honest, I'm by and large disappointed more often than not. So anyway, I've kind of rambled. So Steve, that's kind of what I do. I don't, I did do a lot of sort of analysis when I first bought Apple in 2013, but, like with Deere, of course, I've been following Deere for a long time and reading their financial reports. And, I'm certainly not an expert in manufacturing. I'm not an expert in farming. They generate a lot of their revenues from finance, right? From financing activities. That I understand maybe better. I'm certainly not an expert, but I felt comfortable enough that I think 20 years from now, I'll be happy to have purchased it. I guess we'll find out. Okay. Here we go. Joshua, just saying thank you. I'm a new investor and have been researching and learning like crazy. Yeah, VTI, VIEX, US, and BND. By the way, I'm glad you mentioned BND. I've been meaning to show you guys this. You may have been following this. Let me actually, maybe I can pull this up in Portfolio Visualizer. Let me see. I'll show you on the screen here in just a second. So let's look at, we're going to look at VTI. No, we'll look at S&P. Yeah, we'll do VTI. That's fine. And we're going to compare it to BND. And we're just going to look at this year. Do you remember about a month or so ago, I got a lot of email from folks saying, what are we going to do here, Rob? Both stocks and bonds are down. And people were talking about the bucket strategy. And, if both are down the same amount, rebalancing could force you to sell in a down market. And, what do we do? And at the time, both, I think it was the S&P 500. So we'll look at that. It was down. They were both down, and BND, which is a total U.S. bond market, were both down about 10%, like 9 something, I mean, neck and neck. Now let's see what we got here. Yeah, that's not going to show it to us. We got to go to Morningstar. It's not going to give me what I want. So far this year, BND, I'll show it to you on the screen. Go to performance. We're looking for year to date. That's like a roller coaster. That gets your butterflies going. So it's down, still at about 10%, 9.5%. This is as of, May 20th, so good enough. And then we'll look at VU. Go to performance. Now it was up today a little bit, but it's down 17 and we'll call it 17.5. So already we're seeing, and sorry about the comment on the screen. So already we're seeing the benefits of diversification. Now, You may be saying, yeah, that's great, Rob. Both of them are going down though. Yeah, that's true. And it has happened, doesn't happen very often. 4 or 5 times in the last 100 years but it could happen again, but it's very, very unlikely that they'll both be down the same amount. Again, the year's not up. Who knows what will happen by December 31, but already you're seeing the benefits of diversification. It just may not feel like that. Yeah, anyway. Well, I think so Thomas Yoon, I want to invest in developed markets, but I want to avoid emerging markets. What do you think? I don't think it's the end of the world if you don't want to have exposure to emerging markets. I think it's probably fine, in my opinion. If you wanted to do that, well, there's developed market. Vanguard has a developed market. Let's look it up. I forget the ticker, even though I have shares of it. Vanguard Developed Market Index is VTMGX, I guess, is the, right here. There's an ETF version too. If we go to portfolio, actually, let's look at this in VTMGX. Let's look at it in Morningstar. It's just easier. I think for me, I would prefer exposure to emerging markets. Let me get rid of the comment so you can see this. But again, within if we imagine, a big circle, and in it are all of the reasonable portfolios that one could have, I would include in that circle one that did not have emerging market exposure. Anyway, this one shouldn't, or very, very little. So here we go to region. So what I've done, by the way, I've just put the ticker up here, searched for it, found it, go to portfolio, and then scroll down and you'll see exposure, and it's first set to sector. Go to region, and you can see, well, Europe, there's almost no emerging market anyway, but even Asia emerging is it's very little. So that's one. It's not the only, of course, fund you could choose, but that's one. So I think it's a reasonable approach if you didn't want emerging market. I prefer to have it. That's my preference, but okay. Let's see here. Here we go from Quincy. If you own VTSAX and a Roth, should you use an S&P 500 index and a taxable due to wash sale rules? That's an interesting question. I suppose it's certainly true that if VTSAX is a total market, it's not an S&P 500. Just so we're all on the same page, I'll pull it up. And it's got, what's it got? 3,500 stocks, 4,000. Here it is in Morningstar, VTSAX. So an S&P obviously has roughly 500 stocks. It's actually sometimes more than that, but not by much. And VTSAX, VTI, by the way, is the ETF version. It has, 4,100. So the issue with wash sale is, now it doesn't mention if it's a Roth IRA or 401k, but if you're making regular contributions, say to VOO, 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 or the mutual fund version, and you also own it in a taxable account and you want to harvest some tax losses, you can't have bought the fund 30 days before you took the loss, sold and took the loss, or 30 days after. So it's really a 60-day window. And that can get complicated if you're trying to make regular contributions into a retirement account. Doesn't matter if it's a Roth or not. And so, I hadn't really thought about that, but that would be one way to avoid it. Now, if you sold the S&P 500 in your taxable account and you wanted to stay invested, you could just put it in a total market, right? Or maybe like a value fund that focuses on large companies, if that were your approach, I suppose. But I hadn't actually thought about doing that quite that way. But yeah, that makes sense to me unless I'm missing something, which is very possible. Okay. Okay. Brad says, I've been waiting a long time for a breakdown on someone that has a pension on bond allocation thoughts. Well, I get this same kind of question with Social Security, or maybe even an annuity. You've got some kind of guaranteed income coming in during retirement. How should that affect how you invest your portfolio? And there's probably more than two approaches, but two that come to my mind would be, one is kind of as you've suggested, since it's guaranteed, or at least as guaranteed as anything is in life, right? I'll treat pensions, Social Security, as annuities as at least in part, if maybe not completely, my bond allocation. And how would you actually do that? Well, you'd have to figure out the present value of this, effectively a stream of income, right? Well, again, it doesn't matter if it's a pension, an annuity, Social Security. Maybe you have all three, two of them, whatever. You're getting some, say, monthly income. So you would need to figure out what the present value of that is. There are calculators online. You could do that. And then compare that to the rest of your portfolio. And I guess you could sort of treat that as either all of your bond portfolio, if the numbers worked out that way, depending on what asset allocation you wanted, or part of your bond portfolio. I don't like that approach personally. Now, by the way, I'm not lucky enough to have a pension. So at least at the moment, until I start getting Social Security, this ain't an issue for me. But I don't like that approach. And there's a couple of reasons. First of all, in a lot of cases, that can result in someone saying, well, with my investments, they should be 100% stocks. That's an awfully bumpy ride for someone in retirement. Now, some will say, well, Rob, I can live off of my pension, annuities, Social Security if I have to, so I can take the risk. That sounds good, and it may work out. But, when the market's down 40%, it still hurts. And so you have to really be honest with yourself. Are you going to stick that out? Right? That's the first problem I have. The second one, though, I think is probably more fundamental, and it's this. Regardless of how much income you're bringing in, presumably you still need to draw some amount from your investments. Now, obviously, because you have this income, pension and others, you don't have to take as much, but you have to take, I'm going to assume, you have to take something. And how much you need to take each year from your investments, I think, is a really important question to consider before you make a decision on how you're going to handle all of this. Let's imagine that notwithstanding the pensions, annuities, and Social Security, you still need to take about 4% of your portfolio, say in year one, and maybe adjust it for inflation going forward or to some extent. Then at least what Bill Bengen found in his 1994 paper is that 100% stock portfolio can be a problem. That actually doesn't get you the best results, because we could go through another Great Depression where the market was down 90%, right? That would be the problem with a 100% portfolio. The late 60s were no picnic either. And so I like to figure out how much I need to take from the investments. Fine, I take from pensions and annuities and Social Security first, got it. But do I still need to take from my investments? If so, what percent am I taking roughly each year? And think about asset allocation of those investments on a standalone basis, given what I need to take. If I need to take 4% or thereabouts, I'm personally going to probably follow the Bill Bengen research, to a point, and that's going to put me somewhere between 50 and 75% in equities. Because you can think about it, if you've got to take 4% in year one from your investments, that situation is no different than someone who doesn't have any annuities or pensions and has to take 4% from their investments. It's the same math. Now, someone else might say, well, I don't really need to take anything, or I only need to take 1%. Well, if that's the case and you're comfortable at that level, you can do just about whatever you want. And you just look at the Bill Bengen paper, because he looks at those kinds of withdrawal rates. You could be 100% stocks. You just have to recognize it could be ugly at times. So that's my take, Brad. Yeah. Thanks, Kevin. Though, if you saw me at my worst moment, you'd be less impressed. Yeah, anyway, okay, what do we got? Let's take a look at this one. Josh is reading All About Asset Allocation, a great book. I'll show it to you. Rick Ferry wrote it. I've mentioned it before. Here it is. I'm trying to remember when he first published this thing. This is 2010. Anyway, great book. All right. Not sure I completely understand relationship between asset correlation, volatility, and change in returns. Why are returns lower as volatility goes up? Well, so I'll do my best to answer this. Let's start with asset correlation. We talked about this last week. We want our investments to dance like Elaine Bennis, going this way and that way. We don't want them in sync. That's why, this year when bonds and stocks were both down 10%, people were like, that's not what we want. We want our bonds to be up when stocks are down. That's why we have them, right? Volatility is usually measured by standard deviation, I think. But, generally stocks are more volatile than bonds generally. That means their price swings are greater, right? How all of this affects returns is an interesting question, and I don't remember what Rick had to say about this. And I'm trying to think what best way to describe this. Yeah, I just don't know what he said about it or how he approached this issue. One way to think about volatility is that, and this goes back, you could kind of think I could bring Dave Ramsey into this a bit. There's sort of this debate with Dave about 12%. Is that the return on the stock market? And is that the average? And what average are we talking about? So when we think of averages, at least when I think of averages from grade school math, I'm thinking, you take a series of numbers, add them up, and divide by the number, however many number of numbers there are, right? That's an average, right? The problem when it comes to returns is that what happens in one year affects that balance, and then what happens in the next year affects it. And I can give you an example, because what I just said doesn't really make sense. So let's imagine you have an investment, and in the first year, you make 100%, it doubles. And in the second year, you lose 100%. So what's your average return? Well, if we think grade school math, what's 0%, right? You had a plus 100, a minus 100 equals 0. But of course, we know that in reality, what would happen is, because of that volatility, right? We went broke. We lost all our money in the second year. Our $100 went to $200 in year one, and then in year two it went to 0. So that kind of so the idea of volatility and returns is, if we can smooth out that volatility through proper asset allocation, you can actually end up with higher returns than if your investments were subject to a lot of volatility. But the reason I hesitate, if you notice I hesitated, is a lot of this depends on how you're investing. Are you doing lump sum at the beginning of a time period and moving forward, or are you dollar cost averaging? I'll show you an example. And then I'll try to reread his book by next week and remind myself what he said about all of this. Okay, I'll show you an example. I want to look at, we'll look as an example. This probably doesn't answer his question, the question you raised exactly. But maybe it does a little bit. So we're going to look at ARK, right? Kathy Wood's fund. And we're going to compare it to QQQ, since they're both growth funds, right? And then we'll also compare it to the S&P 500. Why not? And we're assuming a $10,000 investment. And this should go back to like 2015. What? Oh. Try that again. Yeah, 2015, because that's, I guess, when ARK started or thereabouts. And if we look at this, so ARK is the first one, then QQQ. So the winner was QQQ, 32,000. ARK was second, and S&P 500 was last, right? But again, we're assuming a lump sum investment in 2015, which, by the way, I'm going to guess there are very, very few investors who actually invested in ARK and stayed through the whole time. But maybe there's some. Now, let's change these assumptions. We'll assume you started with, I don't know, 250 bucks, and you contributed the same amount each month, changes to monthly. Now, how does it play out? Now, the impact of volatility changes, right? Because we're buying higher and lower as these funds go up and down in price, right, throughout this time period. And so what we see is, let's see, QQQ is still the winner. S&P 500 is next. ARK is in dead last. How we look at this in terms of lump sum versus investing through that period. By the way, taking withdrawals could have a similar effect. It will change the outcome anytime you're moving money in or out. But again, so anyway, I thought those numbers were interesting. I don't know if that's what Rick was getting at. So I will check out his book and refresh my memory, because I probably read it when it first came out. It's been a long time. All right. I don't think my answer to that question was very good. So I get this question a fairly amount. Denise says, which one would be better between equal weighted and market cap weighted S&P 500? So first of all, just so we understand what they are, most S&P 500 index funds are cap weighted, meaning the more valuable each company is in the index, the more of your money goes to that company. So if we look at, we can just look at Vanguard. The question's about S&P 500, but we can look at this fund as well. This is Vanguard's total stock market. We go to the top companies. So Apple is number one. So for every $100, $5.88 goes into Apple. And of course, the numbers go down. And when you get to the 4,107th company, it's probably a fraction of a penny is going into that company. That's a cap weighted, and that kind of that's the norm, right? So an equal weighted, which is where they more or less divide your money equally among all the companies in the index. That's the exception, right? That's the exception. Cap weighted, when people say, I own an S&P 500 index fund, it's market cap weighted. That does get some criticism. And Kathy Wood has criticized it. I don't know specifically market cap, certainly index funds. But I think for me, I've never owned an equal weight. I don't see a need to, because the point to me anyway of an index fund is I want to match the allocation of capital in the market, whatever that is. And capital is not allocated equally between every public company. Some companies are worth more. Some companies are worth less. And I want the index fund to reflect that. So that would be a cap weighted. Effectively, what an equal weighted, say S&P 500 would do would be to reduce the average market capitalization in that fund, so that it almost becomes like a mid-cap fund or close, because it's putting more money into the smaller companies, not more than the larger companies, but more than compared to a cap-weighted index fund. I hope that makes sense. And I just think if you want mid-cap exposure beyond what, say, a total market ETF would get you, then just add 10% or whatever into a mid-cap fund. Would be what I would do. Again, I don't necessarily think equal weighted is some awful thing that you should avoid, but let's see, equal weighted S&P 500 ETF. Invesco has one. I think we've looked at this. What's the ticker? RSP, we have looked at this. Isn't that some sort of retirement fund in Canada? I don't know. Anyway, So, we looked at that total market fund that had what, 5.88% in Apple. So if we look at this portfolio, and that was a total market, not S&P, but S&P would be comparable for cap weighted. This is equal weighted. So if we go to portfolio, Apple won't even be first probably. Yeah. I mean, you can see there's some differences, which I don't fully understand why that would be. It's probably, I do actually. That's probably just price movements of the stocks, and I don't know if they rebalance it quarterly or however, but there's going to be some deviation. But yeah, they're all basically, 0.25, right? So anyway, and by the way, if we go to, let's see, go back up here. Yeah, see, it's basically right on the edge or the line between mid and large cap. S&P 500 would be up here, much larger and more tilted towards growth at the moment, I think. We can look, take a look-see. Yeah, there it is. So I just don't feel the need for equal weighted. That's just me. Oops. I started this comment. I didn't mean to. I mean, it's a good comment, but I don't know why I started, and I don't know how to unstar it. And I don't know what starring it means. Okay, unstarred it. Your current thoughts on gold. So I'm just not an investor in gold because it's not a productive asset. I understand that if it holds its value, at least historically it has, as against inflation, right? But that to me makes it a pretty poor investment by and large. Now, there can be an argument that says put 2, 3, maybe 5% of your portfolio in gold, and you can look at some periods of time when that would have been a good thing. And I don't debate that, but I just don't feel like I need that kind of protection, and I'm not at all confident that gold will really give you that kind of protection consistently. So I'm not one to invest in gold. In some ways, similar to Bitcoin, the rationale. I think of it this way. Imagine you can buy one of two ATMs. Yeah, an automated teller machine. One of them gives you no cash. The other one spits out, pick your number, $1,000 a month, and if things go well, that number can go up. Which one do you want? When you think of it that way, it's like, well, Rob, that's like the dumbest question ever. Why would I take the ATM that doesn't give me anything? Well, it does. There's a market for it. People are buying it, and over time, it goes up by basically the rate of inflation. But still, why would you buy it? Well, the other one that spits out $1,000 a month and can go up, depending on how things go, that $1,000 a month can go down. And sometimes people are really willing to pay a lot for it, but sometimes they're not interested in it. They just don't like it. And so it's a lot, it can be volatile. Of course, the ATM that doesn't spit out anything, that can be volatile too. I just prefer ATM machines that, spit out money. By the way, I've heard criticism of like Buffett and Munger, their attitude towards Bitcoin, because people assume they don't understand the blockchain. Personally, I wouldn't assume that, but maybe they don't. But the thing that people miss that complain about that is that I think what Munger and Buffett would both say is, we don't need to know anything about it. Blockchain could be the coolest thing in the world, but it wouldn't make Bitcoin valuable. It's like the ATM machine. What if he said, well, it doesn't spit out any money, but it runs on the blockchain? Okay, but it still doesn't do anything for me. The blockchain could be great. Maybe there'll be companies that harness the blockchain and in a way that allows them to produce goods and services that people want to buy. And maybe that company will make a lot of profit. Now that I might invest in, because that's just an ATM machine that's spitting out money. But I'm just not interested in ATM machines that don't spit out anything. And, I can hold an ounce of gold for 1,000 years. And at the end of that 1,000 years, I'm just going to have an ounce of gold and hoping someone's going to pay me more for it. So that's my attitude. That's my thoughts on gold. And you're probably sorry you asked me. It wouldn't be the first time. Boy, this is a tough one. Paul, other than I-bonds, how would you suggest a recent retired 60-year-old invest for inflation? I am too conservative right now. I'd like to rebalance for more stocks. Well, I personally think if we end up in a sustained period of high inflation, we don't know that's going to happen. We'll see. It's going to be pretty hard to hide from it. Unlike the 70s and early 80s, we do have TIPS and I bonds. But they can only do so much. I mean, you're buying TIPS now, and yeah, you get the inflation adjustment, but you're still getting a pretty crappy yield. I bonds are good right now because we're at the start of that big jump in inflation. But let's say inflation levels out now, or even goes down a little bit. I think the November inflation rate will be pretty strong. I personally don't think it'll be as high as it is now. We'll see. Who knows? But I think that can only do so much. I do think equities, if you go back and look at history, equities can get killed, all right? Particularly if there's stagflation. But long term, I think they're pretty reasonable. Some would argue real estate, REITs. To me, my approach, I sound like a broken record. My approach is low-cost index funds, well-diversified. I mean, sometimes I'm surprised anyone ever watches this show because I basically say the same thing every week. I mean, I see my job as trying to talk people off the ledge of being really creative with their investing and complexity. I just think a well-diversified portfolio that you stick to is the best approach. Even in inflationary times, I wouldn't venture out into any sort of new approach to investing, at least not in the extreme. If maybe I just wouldn't. So there you go. There's a lot of articles on, and you'll see them. I mean, we could Google it. How to invest during inflationary times. Inflation hurts just about everything. Now, you could say, well, commodities, right? And I get that argument. Of course, if you've got a well-diversified portfolio, you have a lot of exposure to commodities, just not as a separate fund necessarily. But if you own total U.S. stock market, I mean, you're owning oil companies, food companies, precious metal. I mean, you've got Bitcoin exposure, right? Because you own companies that have Bitcoin on their balance sheet, or that whose profit is in some way influenced by the price of Bitcoin or other crypto. So I just generally think that's the best approach, and to have flexibility in your spending as much as you can. I know that's easy to say. Not everyone has that, or some have more than others. I get it. That to me is probably the best approach. That cannot be a satisfying answer, but it's the best I got. Yeah, I hear you, Lisa, but I let mine in. I plugged the little thing in, and I got a discount. I was worried about my wife. Whew. I'm thinking, will our rates go up? Hope she's not watching. I'm just kidding. She is a marvelous driver. Almost said that. No, she is actually. She's better than I am. I think she reminds me that I do think she has fewer tickets than I do. I don't have many, by the way. I think I've had, in my life, 2 speeding tickets. Knock on wood, I've probably just jinxed myself. All right. Kovner, I guess. Thank you for the great content. If I have Roth and traditional options in my 401k, which do you recommend? What are your thoughts on adding VIEIX or VSCIX to an S&P 500 fund? Well, the Roth versus traditional. So generally, the question becomes, is your effective, sort of marginal tax rate, what is it now? And what will it be when you start taking money out of your retirement accounts eons from now? Whether it's because you take money out to live on, or maybe you don't, but then eventually you hit the required minimum distribution, so you start taking money out then. That's the thing we're trying to figure out, right? The problem is, and this is a problem even if you're old like I am. And if my mom's watching, notice I didn't say if you're old like me. So I want credit for that. Anyway, the problem is it's really difficult to know, maybe even impossible to know what your effective tax rates are going to be, right? Why? Well, tax laws can change. Your tax filing status could change. You get married, you get divorced, the spouse dies. You could get to required minimum distributions and then decide to use some of them as qualified charitable contributions that satisfy your RMDs, and you end up not paying any taxes. You've got to factor in, depending on your age and other things that can affect your tax rates, whether it's talking about tax on Social Security. And I don't know how old you are, but let's assume you're not at that age yet, but eventually it gets factored in. So it's really difficult to know what your future tax rates are going to be at the margin. And again, it's not just bracket, it's marginal tax rates. So having said that, I've done my best to guesstimate my bracket in retirement. Again, I just said that it's not just bracket, it's because other things can get factored in, like Social Security tax, IRMA, the extra premiums you might pay on Medicare. But just as a rough rule of thumb, I say, okay, can I estimate my tax bracket in retirement? Now, it's a little easier, not easy, but a little easier for me today than it would have been 30 years ago. And I assume that rates will probably go up, but that's an assumption. Who knows what Washington will do. So what I ultimately say is if my current bracket is equal to or lower than the bracket that I think I'll be in retirement, I would prefer a Roth. I would also be open to Roth conversions. And there's no way for that to be guaranteed. Right? There's just not. Now, if I were just starting off, I think personally, if I were in the lower tax brackets, I'd be doing a Roth. If I were maybe in a higher tax bracket, what would that be today? Maybe 22, 24. But I saw my earning potential going up over time, probably do a Roth. Anything above that, I'd probably be more thinking traditional, particularly if I were in a high tax state, high income tax state, like say New York or California. But again, those are just gross general rules of thumb. You just kind of have to recognize that unless you're at an extreme, highest tax bracket, lowest tax bracket, it's kind of a best guess. Now, there are tools like New Retirement that help you, but even there, you're still making all the assumptions we talked about. Another assumption will be if it's a traditional and you're thinking about a Roth conversion, I know that's not the question you asked, but it's kind of a similar concept, how your investments will perform. Because the fatter your traditional retirements get, the larger your RMD, right? That's one of the reasons I put bonds in a traditional retirement account. Now, VIEIX. I don't know what that is. I think I do. Extended market. So let me show you. This is you asked me about VIEIX. I'm going to leave the comment up on the screen for just a moment. So this is extended market. So if we go to portfolio, you can see the market cap is down here. You could kind of view this, if you took this fund and added it to an S&P 500, right? You'd basically get the equivalent of a total US stock market. I guess I will take the comment off the screen. I don't know if there's any differences, but by and large, that's what you're going to get. So adding this to an S&P 500, perfectly reasonable, or you could just go with a total US stock fund, right? And then your other one was VSCIX. Is that small cap, I guess? Yeah. I think this is a good fund. Some would probably say go small cap value. That's just based on history. Who knows what will actually outperform. But again, understand, I guess the thing I want to sort of stress, though, is that if you went with a total US stock market fund, you'd have small cap, you'd have everything. So that one fund and you're done. The only reason to add, say, small cap would be if you want more exposure to small cap than what a total US stock market fund offers. The other thing I would say is if you have S&P 500 and you get extended, the extended fund that we just looked at, and small cap, there's between the fund and the small cap fund, because the extended kind of includes effectively everything but the S&P 500. I don't know if that's true 100%, but more or less. So I would just go with the total US market. If you wanted to stick with the S&P 500 plus extended, that's effectively the same thing. The only reason then to add small cap on top of all of that, I think, is if you want even more exposure to small cap. Yeah, I think that's right. I think that's my opinion. Yeah. All right. I see a lot of comments about telematics. You guys are not fans of letting the insurance companies into your car. I get it. Now, Melissa, thank you. I cannot believe it's taken this long. This is a new Untuckit. Thank you for noticing. I bought a whole bunch of them thanks to my wife. So yeah, you'll be seeing more. All right. By and large, no. I don't listen to Peter Schiff. I read about him from time to time. And I'm just looking him up on Twitter. Yeah. I don't listen to him, though. Maybe I should follow him. Anyway, I don't listen to him. No. Steve wants to know if I've investigated vertical farming. I have not. Vertical farming. Sounds complicated. Should I? One thing I am looking at are the crowdfunding real estate, like Acre Trader. I like the idea of investing in farmland, although with deer, I get some exposure to that indirectly. People have asked me, you guys have emailed me about Fundrise, so I'm going to do a deep dive on that, and I'll do a video. The thing for me on all of that is, the big question for me is it, I think these are good services. I mean, I've met the folks from Acre Trader. I haven't met the folks from Fundrise, but I'm fairly familiar with it. I mentioned Brandon Turner's Open Door Capital, same concept, not farmland, but some of their deals have been apartments. They've been, other things. I think these are, from what I've seen, good, legitimate avenues of, to consider and to invest in. The thing that personally holds me back is just like, do I really want another added complexity? And the taxes. Now, you can get some tax advantages from it. So that's interesting to me, but I've yet to pull the trigger on all of that. I have no idea what this is about. I don't know. That typo? I'm not sure what's going on there. All right. Back to investing. Noreen, I'm thinking of moving money from FIGRX to FSPSX to save on fees. Your opinion? I'd love to give my opinion. By the way, I'm going to answer this question, but I look back to my screen to go to Morningstar, and I'm reading one of Peter Schiff's tweets, and I'm like, a pinned tweet, no less. America was founded by rugged individuals. Well, I mean, some of them were rugged. Some of them weren't, actually. I wouldn't call John Adams. I mean, he was rugged in a way. Jefferson? Rugged is not the first word that comes to mind. I'm just saying. Anyway, I guess you would definitely call George Washington rugged. That you definitely would do, for sure. All right. Enough of that. Okay, FIGRX. Fidelity International Discovery. So I think we looked at this fund, but it was a long time ago. Let me hide the comment. I'm not going to hide it. I was worried I'll lose it if I hide it, but I'll try to avoid it. So it is expensive. It's 1%. So I would be out of this. I would not be in this fund personally. It's large cap, blend / growth. That's not unlike an S&P 500, right? We looked at that just a minute ago. It's almost the same spot. But it's more targeted, right? It's more focused. 159 companies, and my recollection is that this fund has actually done pretty well. At least the last time I looked at it, it had. Let's put it in here, FIGRX. We'll compare it. I don't know what FSPSX is, Fidelity International. Is this one an international fund? I guess it is. It says International Discovery. All right. So, and then let's just compare it to like, well, we'll just leave it at that. We don't need to compare it to anything else, because is this an index? Yeah. My recollection is the Discovery Fund has done pretty well. Now they're neck and neck, more or less. So this goes back 10 years, right? So Discovery's done a little better. Well, you can ignore that. Actually, how did I put this in here? Oh, I'm still doing the 250 a month. So, you know, the balance, it outperformed a little bit. Let's do lump sum too. I like to do it both ways. So let's do none, and we'll put in, doesn't matter, but we'll put in 10 grand, run the numbers. And it still outperformed a little bit. I like to look at the annual. Yeah, I mean, the problem that I would have, the way I look at this, by the way, so one approach to look at this, say, well, Rob, I mean, even on an after fee basis, FIGRX outperformed. And yes, I understand history can't repeat itself or doesn't necessarily repeat itself. Past returns are no guarantee. But what, I mean, what's going to cause me to pick the underperformer? I mean, like, what great insight do you have, Rob, that's going to suggest I should pick the underperformer, given that I don't know what the future is? And my answer to that question is, if I'm tracking an index and it's a low fee fund, I'm much more likely to stay in that fund come hell or high water. If I'm paying almost 1% for the fund and it's actively managed, and I could be much more likely to bail when things start to go wrong. And even if over the next 20 years, it outperforms the index, during that period, it's going to have problems, because that's just the way life is. And I'm not confident I could stick to it no matter what. So that would be my reasoning for going with the index fund. Okay. Fabiano, welcome. To maximize tax deductions for a self-employed 1099 individual, would you open a solo 401k or a SEP? Well, probably. Well, the first thing I would suggest you do is talk to your tax professional. I'm not one. SEP IRAs are much easier. They're much easier to open, generally cost less. You can put a lot away. In theory, you might be able to put more in a solo. See, I'm not sure of that. The numbers for both, depending on how much your company makes, are pretty big, right? I mean, if we look at the SEP IRA contributions, they're like 60 grand. Yeah, 61,000 in 2022. But you got to make enough money. It's not just, you know, it's based on, if you're an owner, I think it's 20%, but of net income. Solo 401k, you know, you contribute. There's your employer. You know, if you have it contributes. I know that your employer is effectively you or your company. Let's see what contribution limits are. Yeah, the same, but the rules are a little different. So I found SEP IRAs just to be easier to deal with. But again, I would talk to your accountant. You know, another question is, you're self-employed. Is that 100? But you also have a separate job. Like at one point, I was self-employed, but also employed as an employee, and I had a 401k at my job, but could still do the SEP IRA. So there were some advantages there to think about. Mike, I appreciate it. Thank you. From Texas. Matt, thinking of moving out of bonds into VCMDX. I don't know, Matt. This doesn't sound good. I don't know what that is, but I'm a little worried. VCMDX. Oh, commodity. Yeah. Is it commodity strategy? Let's see, portfolio. This probably won't tell us what it invests in, unless it's companies. No. Fixed income. So this tells us nothing. That's okay. Let me go to the Vanguard page. That'll tell us more. The fund's purpose, blah, 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 is a potential hedge against inflation. The fund will rely on commodity derivative securities to maximize inflation protection by seeking to outperform its benchmark. Blah, blah, blah. Reduced long time, well-diversified commodity link exposure will be collateralized with a mix of short-term treasury tips and treasury bills. Yeah, so, and its expense ratio is 20 basis points. I still don't know what it does. I mean, I know what they said. So it is just a commodities fund, effectively. The problem is, I don't have a problem with owning a commodities fund if that's what you want to do, as part of an overall well-diversified portfolio. I personally would never consider replacing bonds with commodities because they don't behave the same way. Now, I don't know how much data we can get on this fund in Portfolio Visualizer, but we can take a look-see. And I'll just compare it to BND. Yeah, we get no data. Is this a new fund? Let's see. Does it have an ETF? I guess not. So it's a brand new fund. So we could do another way we could look at this in Portfolio Visualizer is, because that's just not much data, right? Of course, commodities, as we know, have done great, right? Recently. You can see that 29.58%. Let me get the comment off the screen. But we shouldn't get too excited about that because for a very long time, commodities performed poorly. Let's see, can we do it here? So let's do intermediate term treasury, 100%, and then commodities. So this is just on an asset class basis. So this is going back, this is only going back to 2007. That's what they have for commodities, but it gives you a picture of just how poorly commodities have performed since then. It's just been terrible. Now, again, maybe we're in, like you said, we're in an inflationary period. Maybe, who knows? Maybe the next 10 years you'll love commodities and hate bonds. But to me, I mean, and also you look at the volatility of commodities, 24% standard deviation. It's just, they're two totally different investments. And I just don't think, in my opinion, I don't think commodities will serve the purpose of bonds. Again, you know, if you want to have whatever 5% in commodities fund, you wouldn't get any objection from me. But I personally would never consider replacing my bonds with commodities. Phil says, thoughts on growth versus value in the near term? I really have no thoughts on growth versus value in the near term. It's certainly, I think, true if rates continue to rise, value will do well relative to growth. But I don't know if rates are going to continue to rise. I mean, if I were betting, I would, yeah, I guess I would bet that they're over the next rest of the year, they'll go up. I don't mean the Fed's rate. That I would definitely bet would go up. But like, will the 10-year treasury be higher in December than it is now? I don't know. I generally prefer a value approach to investing. I always have. Most of the stocks I own. Is Deere a value fund or a value company? Probably is after it lost 14%, although it was up today. I have no idea. Does Morningstar categorize? They do categorize them this way, right? Let's take a look. Maybe. It's a core. It's in the middle. But I like the value approach to investing. I always have. It just suits my personality, my approach to investing. But I have no particular opinion about how they will perform relative to each other in the near term. And I think that's important. I mean, I think it's important to recognize that we don't know. And at least in my opinion. Everything I say is in my opinion. What was the show? Was it The Good Wife? Where they had a judge, and whenever the lawyers said something, she would interrupt them. In your opinion. I think that's what she said. It's like, yes, judge, in my opinion. I could have the show wrong. I don't think so, though. Mr. I guess Rocker Dude. If inflation pushes savings rates to above average, to above average stock market returns, I'll take 9.3% from your book. Yeah, which also, by the way, so that was the my assumed return rate for, I think it was a diversified portfolio, and the number at the time came from Vanguard. I didn't make it up. Why not stop investing and just start plowing money into savings? Well, so there's some problems with this. First of all, when we talk about stock market returns, over what period of time are we talking? Because if the answer is, well, just this year, I don't think that's a good metric to use, frankly, for anything. And if you're talking longer term, think 10 or 20 years, I probably wouldn't believe that savings rates will outperform, although I guess it's possible. But the other concern would be if inflation does what you've suggested, savings will guarantee you a loss of purchasing power, right? Because they're going to be the interest you're going to get at an FDIC insured account, at least for the foreseeable future, will be well below inflation. Now, of course, you could say, well, but stocks are going down. Yeah, and that's just part of the bargain. You know, if you own a business, you own a dry cleaner, the value of it goes up and down. You may not see that because it's not publicly traded, but the value of your business is going up and down every single day. Do you go out and sell it because it's down, or do you start selling puts? Well, you probably couldn't, but if you could, no, it's a business. You evaluate it. Cash is coming in, good. I'm happy. That's how I think about Deere and Apple and Bank of America, Berkshire. So, yeah, I mean, long term, I think stocks are the better investment, and short term, who knows? And I just don't feel like I can forget the tax issues. Even I can't predict the market well enough to time it to get in and out, and just can't do it. I don't think anyone can. This is an interesting question because this is coming up like with Apple too. And I don't know. I don't have an answer to that, Jim. Yeah, I don't know. I don't know if it's factored in. I mean, I don't know that I could ever know if it's factored into Deere's price, at least at this now. I suppose eventually. I also don't have a sense as to the impact it'll have on their service revenue. So I don't know. Vinyl, it's okay. Just please don't let it happen again. All right. Oh, well, Vinyl, look at this. He's up 3% year to date in his portfolio. Oh, portfolio of dividend stocks. I don't know if that's 100% of his portfolio. Well, good. Good for you. So Igor says I have about 120,000 in cash. He's thinking 70% VTI, 30% VIEX US. I'm trying to time the market. Oh, I like it. At least he knows what he's trying to do. He started buying at 226 a share and 196 a share. So from an equity perspective, VTI and VIEIX US, I love them. Think they're great. 70-30 seems reasonable to me. Now it's a 100% stock portfolio. I've given you my thoughts on that in the past. Timing the market, yeah, I just don't think that's. You might get the worst thing that can happen is you could time the market once and it work out for you, because then you think you figured it out. See, you're better off getting burned the first time than you don't do it again. That's my view. You know, when I bought Deere on Friday, some might say, well, weren't you timing the market? Not at all. And in fact, it was up today, like 7%, but it could fall well below what I paid for it. I have no opinion. What was it up today? 7.04%. I should have put $1 trillion into Deere. Didn't have that cash lying around. But I have no idea what it's going to do in the short term. But I do think 20 years from now, 10 years from now, yeah, it'll be a good business, and I'll be happy I was part of it. But yeah, time in the market, it just something that works. All right. Oh, here's a good question from Paul. Hey, Paul. Paul, I think you're the same Paul that emailed Michael Kitsis and me to try to connect us. I've actually emailed with Michael in the past, and I don't think either one of us responded to that email. I think it was you. It was a Paul. I am going to reach out to him and see if he wants to come on the show. Maybe he'll do a live show with us. Yes, it was you, Paul. Anyway, I haven't forgotten about that email. Can you demonstrate with actual numbers how having a 60-40 allocation can really make a difference when stocks are down? Seems like it wouldn't make that much of a difference. I don't know if I can. Let's find out. We can do that. We can just use I think we can just use Portfolio Visualizer. Let me get your comment off the screen for everybody. And we'll just do asset allocation because we'll get more data. And we'll put a portfolio in here. Let's do the Bogleheads 3 fund, but we'll make this 40, right? So we'll make this what, 30 and 20? Did I add that up right? I don't think I did. We'll do 35 and 20. Yeah, we'll do 40 and 20. Whatever. That equals 100. So that's portfolio 1. And then for portfolio 2, we'll just do 100% stocks, I guess, right? Does that seem fair? So we'll just keep the same asset classes, 70-30. And we know, so this goes back to 87. So we know, and we're just starting off at the moment with a lump sum investment, 10 grand. Let's live a little. Let's make it 100 grand. All right. There we go. Now we got some numbers. So of course we know that portfolio 2, that's 100% stocks, outperformed, right? Although it's interesting, this started all the way back in 86, right? Now the red line is portfolio 2. I mean, yeah. So let me give these names. It'll be easier. I think I can give them names. Names, custom. So we'll call this 60-40, and we'll just call this 100% stocks. All right, there we go. So the blue is the 60-40. What I find interesting, this started all the way back in 1986. We can come all the way up as far as 2012, and they're neck and neck, right? That's a long time. Think about that, 60-40, neck and neck. Now, we all know we've had this bull run the last decade, and so the 60-40 fell behind. But for long stretches of time, 60-40 can keep pace with the 100% stock portfolio, and this gap could easily close. It's closing this year a little bit, not a lot, because bonds have been down too, but this gap could close. And particularly, most people, I think, that are thinking 60-40, Paul, like folks like maybe you and me, although I don't have a 60-40 portfolio, but we tend to be a little closer to retirement. And so, these sorts of years, this was the tech bubble bursting, right? So here, leading up to the tech bubble, people were making fun of the 60-40, right? Because it's fallen behind. Here, the 100% stock people probably didn't stay 100% stocks because that's hard to stomach. And it's hard to stomach here too. This was 2008. And so a 60-40 portfolio really takes a lot of the volatility out of, a portfolio compared to, say, 100% stocks. So, and you can look at the standard deviations. Big difference, 15 versus 9. It's pretty significant. Now, again, we're comparing extremes. We could compare, say, a 60-40 to whatever, an 80-20 or 90-10. But, yeah, when stocks are down, a 60-40 does generally protect you. Even this year, by the way, there's some protection, not a lot because bonds are down. We'll see how it is at the end of the year. So, but yeah, historically, it does give you some protection on the downside, as bonds generally do. All right, great question. Passive 101, 80%, their portfolio is 80% VT, which is just a total global equity ETF. And 20%, yeah, is that right? Yeah, that's right. But why 20% in an S&P 500? Maybe it's just to get the mix you want. Hang on. Whoops, let's see. Where's my Morningstar? So VT is the world, right? Yeah, World Stock Index, and pretty sure VSIEX is the S&P 5. Oh, it's small cap. Okay. So, okay, they're all in my 401k, Roth, and HSA. Is this a good mix? Well, again, it's 100% stocks. I've talked about that. There's some overlap there, but I guess what you're trying to do is get greater exposure to small cap than what VT by itself would give you. And I can't argue with that approach. So, I mean, assuming you want a 100% stock portfolio, I think this is one way to go about it that, again, I would put in the circle of reasonableness. That's what this is. Wouldn't be my approach exactly. I'm not personally a fan of VT because I prefer to control my international exposure, but I don't think it's an unreasonable approach at all. I get this question, I think once a week. Are covered call ETFs a good alternative to bonds? No. Also, I'm in a low tax bracket, married with 3 kids, $50K a year. Should I be concerned about taxes right now? Well, let me start with the second question. I think you should always be concerned about taxes, but I don't know what you mean by that. So, again, concern might be the wrong word, though. You should always factor them in, depending on your circumstance. If I don't know how to, I don't know what the specific concerns you might have would be. Covered call ETFs. So in a falling market, covered call ETFs actually do well because the options aren't getting called or going down in value if the market's falling. But long term, they're just not good. Let me see if I can give you an example. Let me pull up a covered call ETF. We'll do it on an S&P 500. I don't know what you specifically have in mind. XYLD. So I'll show you this on the screen here in a second. XYLD. I don't know how much data we'll get for this. Let's see. Here it is. I'll leave the comment up for a moment if it's not in the way. We get some data. So this is a covered call ETF on the S&P 500. And I don't know, the covered call ETFs that I've looked at buy options at the money. So the strike price is basically the same as what it's trading at. You can buy in the money, out of the money, or sell in and out. So they sell, I don't know, I haven't looked at this specific fund if I have in a long time, Normally, I think they sell them at the money. We can actually look that up, I guess. Let's see here. Here's the actual. I'm looking to see if they buy them at the money. I think they do, or sell them. They don't say here. Anyway, it doesn't really matter, I guess. Having said all that, it probably doesn't matter. So, the question is, are these good alternatives to bonds? Here's one of the reasons some might think they are. If we go back to this page and we look at its what it's paying in income, look at this. Let me make this bigger. This is a very attractive number. I will be the first to acknowledge that. 12-month trailing yield, 11.81%. It's like, what? Are you kidding me? And it just seems like it's too good to be true. The problem is, particularly when the market's going up, is you're getting that income, but you're losing value, right? The value of the shares. And so if we go back to Portfolio Visualizer and we say, okay, let's just compare this first with an S&P 500, okay? So we'll compare this to VIEIX. Which one does better? And you can see VIEIX crushed it, 12% versus 7%. Now, this year, I would guess the covered call ETF has outperformed. Has to, right? Yeah. Because the market's down. And, you know, if you a covered call, let me get rid of the comment for a second. A covered call, if you sell a call option, you're selling someone an option to buy your shares from you at an agreed upon price. The option will last for an agreed upon period of time. They can exercise the option if they want to anytime during that agreed upon period of time, a few weeks, months, years. So if you're selling the covered call and the strike price, the price they can buy it, the shares from you is, let's say, at the money. So you've got shares worth $100 and they can buy them from you for $100. Well, if we're in a bear market or a down market and the shares drop to 80, well, they're not going to want to buy your shares for $100. So you get to keep the premium that you made when you sold the call option, and you get to keep your shares, but you just keep collecting this premium. On the other hand, if the value of the shares go up, they're going to buy them away from you at the $100. It just makes sense. So anyway, but your question wasn't comparing it to the S&P 500, was it? It was comparing it to bonds. I have no idea. Let's look. The issue here, well, let's take a look at the numbers first. So again, it's here. So over the last however many years, 7, 8, it's actually done quite well over bonds. Now, what's interesting about this is, again, it started to do well in this period, but then with COVID, it was a disaster, and the bond market was actually outperforming. Since then, the covered calls have done much better, and of course, bonds have come down. The issue that you'll have, and the reason that I don't like them as a bond alternative, is volatility. So you can see here the standard deviation on the covered call ETF is 12%, and for bonds, this is a total bond market fund, under 4%. And I want bonds for this stability. And if I'm going to take on more volatility, I would personally just invest in the S&P 500. So that's my take on it. And it's 8:34, so I got to call it a night. Thanks, by the way. I know I originally was going to do this at 8, as I said at the beginning. That got kind of changed. Next week, I'm going to do this show on Tuesday. So it'll be Tuesday the 31st at 7, because Monday is Memorial Day. And I won't be doing the show on Memorial Day, but next Tuesday, the 31st, I'll do it then. If you haven't subscribed to the newsletter, I mention this each week, but there's a link. There will be a link. Actually, I didn't add it. But as soon as this show's over, I'll go into the video and I'll add the link. I think you'll find it very useful. I think people seem to be happy with it that have subscribed. And there's a lot of content that I'll often put in articles that I find that relate to some of the things we talk about on this show. So, you know, not always, depends what's going on. There was one article that I meant to put in last week's. Let me see if I can find it real quick. Yeah. Was it this one? See if I can pull it up. It's relevant. Bear with me. Yes, here it is. You won't be able to see the article very well. I'll put it in this upcoming Sunday if I don't forget. This guy, Harold Avensky. Who knows who Harold is? He is the bucket guy, the bucket strategy. He came up with the bucket strategy. But the bucket strategy he came up with, there were only two buckets, cash and then investment. So I'm not even sure it's fair to call it a bucket strategy. I mean, you have your investment accounts and basically a checking account. Isn't that how everyone, I mean, if that's a bucket strategy, isn't that what everyone does at a minimum? I don't know, in retirement? Anyway, the thing I liked about this article is he was saying, look, you know, people have taken that idea and they've sort of shaped it into a 3-bucket strategy or even more complicated. He doesn't like that. I don't know. I think Harold and I agree on the bucket strategy, at least as others have sort of translated it. Anyway, I'm going to throw that in next week's newsletter. I meant to put it in this week's and I forgot. And that's about it for today. I'm just flipping through. It's amazing how many comments I don't get to. And maybe it's a good thing. I come down and I look at some of these comments. I'm like, really? Any non-retirement, non-investing questions? I always like those. Paul, you are more than welcome. So now we're talking. Vinyl. Why don't you get Untuckit to sponsor your videos? I want to be like on a poster at their store or something. Probably have to really Photoshop it. Yeah, I should. I don't know. Maybe they've seen the video and they're like, yeah, we're kind of going for a different look there, bud. What else we got? Yeah, he is so this is Peter Schiff. He is a sort of a sky is falling guy. Yeah. It's interesting to me how many people really are, you know, the sky is falling. And here's the thing. If we look back in history, sometimes the sky is falling, but it's rare. And I guess eventually, I mean, people predict it always. It's always being predicted. Always, always, always. So I guess at the very, very end of, I don't know, a nation, not the end of it, but it's of its dominance, somebody's right? But it's unreal to me how many people predict calamity all the time. Now, you know, I live in the Washington, D.C. area, home to the Washington Commanders. So I get calamity. I understand it. All right. VJ, you are here. Yeah, I haven't read it yet. I want to do a book group, which I've talked about. I'm working on it, but that's going to be our first book if we do it, Psychology of Money. I put in a an article by the author of that book in last week's newsletter that was really good, I thought. All right. I'm just going to go all the way to the very bottom. Oops. Try this again. There it is. Thanks, Mike. Appreciate it. All right, gang. Have a great week. I will have some other videos coming out. I am doing the blue binder video. I know I keep saying that. You should just stop listening to me. But I'm going to do that this week, although this week is tricky. But I'm going to do it this week. And again, next Tuesday at 7 p.m. Have a great Memorial Day weekend. And yeah, until next time, remember, the best thing money can buy is financial freedom, not a covered call ETF, in my opinion.